Something fundamental has shifted in global markets. And if you're watching this video, you likely already sense it. Silver prices in China have crossed a threshold that most analysts said was years away, if it would happen at all. We're seeing physical silver trade above $100 per ounce in certain Chinese markets, while Western exchanges show prices that still don't fully reflect what's happening on the ground in the world's largest manufacturing economy. This isn't a story about a single commodity. This is a story about monetary stress, supply chain reality, and the gap between paper markets and physical assets. And it matters whether you currently hold silver or you've been watching from the sidelines. I'm not here to tell you to panic. I'm not here to promise you riches. I'm here to walk you through what's actually happening, what it means in the context of larger economic forces, and how thoughtful investors approach moments like these. Because if you understand what's driving this move, you'll make better decisions regardless of which side of this trade you're on. Let's start with what changed. For years, silver has traded in a relatively tight range, often dismissed as just an industrial metal or overshadowed by gold's monetary reputation. The narrative was stable. The price reflected that narrative. But narratives break when reality intrudes. And the reality intruding now is a convergence of forces that have been building for years. China's domestic silver market is showing prices significantly above what you see on the COMEX or London exchanges. This spread isn't just noise, it's a signal. When physical metal in the world's largest industrial economy trades at a premium to paper contracts in Western financial centers, it tells you something about supply, demand, and trust. It tells you that buyers who need actual metal are willing to pay more than what futures contracts suggest the metal is worth. That's not speculation. That's scarcity. Now, before we go further, let's be clear about something important. Markets are volatile. Prices spike and correct. What seems dramatic today might look different in 6 months. But understanding why something is happening helps you respond intelligently rather than emotionally. So what's actually driving this? Let's break it down without the complexity that usually clouds these discussions. First, there's the monetary backdrop. Central banks around the world have created more currency in the past 15 years than in the previous century combined. That's not hyperbole, that's measurable fact. When currency supply expands dramatically, the purchasing power of that currency relative to real assets changes over time. This doesn't happen overnight. It happens in waves, in cycles, with periods where the effects seem invisible and other periods where they become undeniable. We may be entering one of those undeniable periods. Second, there's the supply side. Silver comes from mines, and mines don't expand overnight. The easy deposits were found decades ago. Today's production requires more capital, more energy, and more time. Meanwhile, demand from solar panels, electronics, electric vehicles, and industrial applications has grown steadily. The market was balanced, barely, when everything was predictable. But predictability is a luxury that disappears when geopolitical tensions rise, when trade routes get complicated, when nations begin securing strategic resources, rather than assuming global markets will always provide. Third, there's the psychological shift. For years, investors treated precious metals as relics, as old-fashioned hedges that underperform technology stocks. That dismissiveness created a situation where very few new investors entered these markets. Exploration budgets were cut. New projects were delayed. The industry shrank. Now, as inflation proves stickier than central banks predicted, as currency volatility increases, as geopolitical fragmentation accelerates, a new generation of investors is discovering what previous generations understood. Real assets have properties that financial assets don't. Here's what most commentary gets wrong about moments like these. They focus on the price. They focus on the percentage move. They ask whether it's a bubble or whether it's going higher. Those are the wrong questions, or at least they're incomplete questions. The right question is, what is this price move telling us about underlying conditions? Because price is information. Price is the market's way of balancing supply and demand, balancing fear and confidence, balancing the present and the future. When silver moves sharply higher, especially when physical markets lead and paper markets follow reluctantly, it's telling you that the physical balance is tighter than the financial models assumed. It's telling you that someone, somewhere, needs metal and can't get enough at the old price. This happened in other commodities over the past few years. It happened in copper, it happened in lithium, it happened in nickel. Each time the initial move looked excessive. Each time analysts said it would correct immediately. Each time the correction was smaller than expected because the underlying shortage was real. Silver is different from those industrial metals in one crucial way. It's also money. Humans have used silver as money for thousands of years. That history doesn't disappear just because we've spent a few decades using paper currency. That history sits in the collective memory waiting for moments when paper seems less certain. Let's talk about how markets behave during periods of monetary transition. And let's be clear, that's what we're experiencing, even if most people haven't named it yet. In the 1970s, when the post-World War II monetary system broke down, gold and silver went through a decade-long bull market punctuated by violent corrections. People who bought early and held through the volatility did extraordinarily well. People who chased the final spike in 1980 got hurt badly. In the 2000s, after the tech bubble burst and central banks began their first major intervention experiments, precious metals went on another decade-long run. Again, volatility. Again, corrections that shook out weak hands. Again, strong returns for patient holders. We're now in the third major monetary experiment. Massive currency creation combined with unprecedented debt levels, aging demographics in developed economies, and a shift from globalization to regionalization. History doesn't repeat, but it often rhymes. The pattern in these cycles is consistent. First, a small group of investors buys when nobody cares. Prices are low, sentiment is terrible, and the asset feels forgotten. Then, conditions change. Supply tightens, or demand increases, or monetary policy shifts. Prices start rising, slowly at first. Then comes the phase we might be entering now, recognition. More investors notice. Media coverage increases, prices move faster. This phase feels exciting, but also unstable. Corrections happen, doubts arise. But the trend continues because the underlying forces remain in place. Finally, if the cycle runs its full course, there's euphoria. Everyone wants in. Prices spike dramatically. That's when disciplined investors start taking profits, not adding positions. That's when risk is highest, not lowest, even though it feels the opposite. So, where are we now? That's the crucial question, and nobody can answer it with certainty. But we can make informed assessments. Silver is not in euphoria. If silver were in euphoria, your neighbor would be talking about it, your colleagues would be buying coins. Financial news networks would lead every broadcast with it. We're not there. Most people still don't own any precious metals. Most people still don't understand why they would. What we're seeing is early stage recognition. A subset of investors, particularly in Asia, are acting on information about supply constraints, about currency risks, about the changing global order. They're buying physical metal. That buying is moving prices. Western investors are watching, curious, but still skeptical. The financial establishment is still explaining why this can't last. That skepticism is actually a healthy sign that we're not in a late-stage bubble. But here's what's different this time compared to previous cycles. The scale of the monetary experiment is larger, the debt levels are higher, and the geopolitical fragmentation is deeper. That doesn't guarantee prices go higher. It means the forces creating demand for hard assets are more powerful than in previous cycles. If you already own silver, physical, or through well-structured positions, this moment requires discipline, not celebration. Yes, your position is worth more than it was. That's good. But the question isn't whether you're winning today. The question is whether your reasons for holding are still valid and whether your risk exposure remains appropriate. Why did you buy silver originally? If you bought it as insurance against monetary instability, that reason remains valid. The instability hasn't been resolved. It's been postponed through more currency creation. Your insurance thesis is intact. If you bought it because you understood the supply-demand fundamentals, has anything changed? Mines haven't suddenly become more productive. Industrial demand hasn't disappeared. The fundamentals remain supportive. If you bought it because you study cycles and recognize we're in a period where real assets tend to outperform financial assets, that cycle isn't complete. These cycles run for years, not months. But here's what you shouldn't do. You shouldn't assume this price is the new floor. Markets don't move in straight lines. There will be corrections. There will be days or weeks when prices pull back sharply. That volatility is normal. It's the cost of being in an asset class that's repricing. You also shouldn't leverage up because you're winning. The worst investment decisions often come after a period of gains, when confidence turns to overconfidence. Keep your position size rational relative to your overall portfolio. Keep your time horizon long. Keep your emotions in check. If you don't currently own silver and you're watching this unfold, you're probably experiencing one of two emotions: regret that you didn't buy earlier, or skepticism that this move is real. Both emotions are understandable. Neither is helpful. Let's address regret first. Yes, silver is higher than it was 6 months ago or a year ago. But if the underlying thesis is correct, if we're in the early stages of a repricing of real assets relative to financial assets, then the opportunity isn't over. It's different, but not over. The mistake would be to chase price emotionally, to buy because it's going up, without understanding what you're buying and why. That's how people get hurt. They buy the story, not the asset. They buy the momentum, not the fundamentals. And when the inevitable correction comes, they panic and sell at a loss. If you're going to allocate to silver now, do it thoughtfully. Understand what role it plays in a portfolio. It's not a speculation on getting rich quick. It's a hedge against monetary instability and a bet on supply-demand fundamentals in a critical industrial metal that also has monetary properties. Start small if you're starting now. Average and over time. Don't put money into silver that you'll need in 6 months or even 2 years. This is a multi-year thesis, not a trading opportunity. Now let's address skepticism. Maybe you think this is a bubble. Maybe you think paper silver contracts will reassert control over the price. Maybe you think central banks will tighten enough to create deflation and crush commodity prices. All of those are possible. Markets are probabilistic, not deterministic. But ask yourself, what's your alternative thesis? If you're avoiding silver because you're confident in the stability of currency, in the health of government finances, in the return to globalized trade and cheap commodities, are you being realistic? You don't have to believe silver goes to $200 or $300 to justify owning some. You just have to acknowledge that monetary risk is real, that supply constraints are real, and that having some exposure to real assets makes sense in an environment of uncertainty. Let's talk about something that doesn't get enough attention in these discussions. The debt trap that governments, particularly in developed economies, find themselves in. The United States has over $36 trillion in official debt. That number grows by over $1 trillion every 100 days at current rates. Interest on that debt is now one of the largest line items in the federal budget, exceeding defense spending. Europe has its own debt problems, complicated by demographic decline and energy dependence. Japan's debt-to-GDP ratio is the highest in the developed world. China's local government debt is enormous and growing. This isn't a moral judgment. It's a mathematical reality. And the mathematics of debt only work in 3 scenarios: growth high enough to outrun the debt, inflation high enough to devalue the debt, or default. Real growth of the type needed to solve this problem would require productivity increases we're not seeing. That leaves inflation or default. Default on sovereign debt in major economies would be catastrophic. So the path of least resistance is inflation. Not hyperinflation necessarily, not Weimar Germany or Zimbabwe, but sustained inflation above what central banks target, eating away at the real value of debt over time. That's the most politically palatable path, and it's what history suggests happens in these situations. If that's the path, and if you believe it's at least a likely scenario even if not certain, then hard assets make sense. Not all of your portfolio, not a speculative amount, but a meaningful allocation. Silver, in this context, is both an industrial metal that becomes scarce in an inflationary environment and a monetary metal that benefits when currency credibility declines. That dual nature makes it interesting. Here's something specific about silver that matters. Above-ground inventories are much smaller than most people realize. For decades, silver was produced as a byproduct of other mining operations and wasn't valued highly enough to justify dedicated silver mines. Governments held large stockpiles, left over from when silver was money. Those stockpiles were sold off over the years, keeping supply ample even as mine production struggled to keep up with demand. Those government stockpiles are largely gone now, and mine production, despite higher prices, can expand quickly. It takes 7 to 10 years to go from discovery to production for a new mine. Existing mines are depleting. Meanwhile, industrial demand grows. Solar panels use silver for electrical conductivity. Each panel contains a small amount, but billions of panels means substantial demand. Electric vehicles use more silver than traditional cars. 5G infrastructure requires silver. Medical applications use silver for its antibacterial properties. This is before considering investment demand. If even a small percentage of global wealth decides to allocate to physical silver as a monetary hedge, the available supply is minuscule compared to the amount of capital that could flow in. Some analysts argue that recycling will fill the gap. There is recycling, and it helps. But silver in solar panels isn't easily recyclable at current prices. Silver in electronics gets recycled, but not efficiently. The recycling rate, while meaningful, doesn't come close to covering the annual deficit between mine production and total demand. This is why the price in physical markets is leading. The people who need actual metal, who can't simply roll a futures contract forward another month, are discovering there's less available than they thought. This brings us to something important and often misunderstood: the relationship between paper silver markets and physical silver markets. Most silver owned by investors doesn't exist as physical metal sitting in a vault assigned to them. It exists as contracts, as shares in funds that may or may not be fully backed, as derivatives that settle in cash rather than metal. This paper market serves a purpose. It provides liquidity, it allows hedging, it facilitates price discovery, but it also creates a situation where the amount of silver claimed by paper contracts far exceeds the amount of physical silver available for delivery. This works fine when everyone trusts the system and nobody asks for actual delivery. It becomes problematic when trust wavers or when a significant number of participants demand physical metal. What we're seeing in China is a glimpse of what happens when physical demand overwhelms the paper structure. Buyers go directly to the source. They pay premiums. They accept delivery delays. They secure supply. If this dynamic spreads, if investors in other regions begin demanding physical rather than trusting paper claims, the price discovery mechanism shifts. The paper market, which has effectively capped prices by creating unlimited paper supply, loses control. This doesn't happen overnight. The financial system has mechanisms to manage it. Margins get raised, deliveries get delayed, contracts get cash settled rather than physically delivered, but each of those responses further erodes confidence, creating more demand for physical. Let's talk about how investors actually behave versus how they think they'll behave. Everyone watching this video believes they'd be disciplined during volatility. Everyone believes they'd buy low and sell high, that they'd stick to their plan, that they wouldn't let emotions drive decisions. But statistically, most investors do the opposite. They buy after assets have risen when confidence is high. They sell after assets have fallen when fear is high. They trade too much, chase performance, and underperform simple buy and hold strategies. This isn't because people are irrational. It's because markets are designed to be uncomfortable. Markets punish certainty. The moments when buying feels easiest are often the worst times to buy. The moments when selling feels necessary are often the worst times to sell. Silver is particularly susceptible to this because it's volatile. It can drop 20% in a month during a bull market. It can go nowhere for years, even when fundamentals remain supportive. It requires patience that most investors don't have. If you're going to own silver or any volatile asset, you need a framework that's independent of price action. You need to decide in advance what percentage of your portfolio it represents, when you'd add to it, when you trim it, and what conditions would make you exit entirely. Without that framework, you'll be driven by emotion. You'll buy more after it's risen because you feel smart. You'll panic sell after it drops because you feel scared. And you'll end up transferring wealth to more disciplined investors who have a plan. This section matters as much as anything else we've covered. Let's be explicit about mistakes to avoid. Don't buy silver on leverage unless you're a professional trader with risk management systems and the ability to handle a total loss. Leverage magnifies gains, but it also magnifies losses. And in volatile markets, it guarantees you'll get stopped out at the worst possible time. Don't put money into silver that you need for living expenses, for emergencies, or for any purpose with a defined time horizon. This is long-term capital, patient capital, capital that can sit through years of volatility if necessary. Don't chase price action. Don't buy just because it's going up. Don't sell just because it's going down. Have a thesis, have a plan, execute the plan regardless of what prices do day to day. Don't follow influencers or personalities who promise you riches. Nobody knows what silver will do tomorrow or next month. People who claim certainty are either lying or deluded. Learn to be comfortable with uncertainty. Don't ignore other aspects of your financial life. Silver is one asset class. You still need cash reserves. You still need diversified investments. You still need to live your life and fund your goals. Don't become so obsessed with one thesis that you neglect everything else. Don't buy without understanding what you're buying. If you buy physical, understand storage and security. If you buy through funds or trusts, understand the structure and counterparty risk. If you buy mining stocks, understand the leverage and operational risks. Knowledge reduces anxiety. We need to address specifically what's happening in China because it's driving current price action. China is the world's largest solar panel manufacturer, the largest electronics producer, and increasingly a major player in electric vehicles. All of these industries consume silver. China also has a population with a cultural affinity for precious metals and a recent history of currency controls that make hard assets attractive. When Chinese buyers move into a commodity market, they move with size. We saw this with copper, with soybeans, with iron ore. They think in terms of securing supply for strategic industries, not in terms of quarterly trading profits. The premium in Chinese physical silver markets reflects both genuine industrial demand and growing investor demand from a wealthy population that doesn't fully trust their currency's long-term stability. That's not a criticism. It's an observation based on capital controls, property market stress, and demographic challenges that make Chinese savers cautious. If Chinese demand continues at current levels, and if it's joined by demand from other Asian economies, Western exchanges face a choice. Allow physical prices to rise to clear the market, or risk a credibility crisis where paper prices become obviously divorced from physical reality. Neither outcome is certain, but the trend is clear. Physical markets are asserting control over price discovery in a way they haven't for decades. Let's address the argument that higher interest rates will kill precious metals. The theory is simple. Gold and silver don't pay interest, so when rates rise, investors prefer bonds. The opportunity cost of holding non-yielding assets becomes too high. This theory worked for years. It's why precious metals struggled after 2011, when central banks projected confidence and slowly raised rates. But something changed in this cycle. Rates rose dramatically in 2022 and 2023, the fastest hiking cycle in decades. And yet, gold made new all-time highs. Silver is now breaking out. The traditional relationship isn't working the way it used to. Why? Because real rates matter more than nominal rates. Real rates are what you earn after accounting for inflation. If a bond pays 5%, but inflation is running 4%, your real return is 1%. If inflation is actually higher than official statistics suggest, your real return might be negative even with seemingly attractive nominal rates. Investors are learning that government bonds aren't the safe haven they assumed. Default risk might be low, but purchasing power risk is real. That's driving some allocation toward real assets, even in a higher rate environment. There's also the recognition that rates can't stay high indefinitely with debt at these levels. The interest expense becomes unsustainable. Central banks will face pressure to cut rates or allow inflation to run hotter than they'd prefer. Either scenario supports hard assets. This doesn't mean rates don't matter. A genuine return to Volcker-era monetary discipline would hurt precious metals. But the conditions that allowed Volcker to break inflation, lower debt levels, political will to endure pain, demographic growth, don't exist today. If you've made it this far in this video, you're not looking for quick answers. You're trying to understand. That's the right approach. Understand this. What's happening with silver is part of a larger repricing. It's part of a shift from financial assets back toward real assets, from paper claims toward physical ownership, from trusting institutions toward verifying reality. That shift isn't linear. It will reverse temporarily. It will frustrate you. But the underlying forces, debt, demographics, deglobalization, and monetary experimentation, aren't going away quickly. Patient investors, the ones who recognize cycles and position before consensus, are rarely comfortable. They bought gold in 2001 when it was under $300 and everyone said it was a barbarous relic. They held through corrections and bought more. By 2011, they'd seen 5x gains while others were still debating whether gold was real money. They bought Bitcoin when it was dollars, not thousands of dollars, and held through 80% corrections multiple times. They understood the technology thesis before it became mainstream. They're buying silver now, or they bought it years ago because they understand supply constraints and monetary reality. And they'll hold through volatility because their thesis isn't based on price action. It's based on fundamentals that play out over years. You don't have to be an early adopter to benefit from these cycles. But you do have to be early enough, and you have to be patient enough. And you have to be honest enough with yourself to admit when you don't understand something rather than pretending you do. Everything we've discussed is a probability assessment, not a guarantee. So let's talk about managing risk in an environment of uncertainty. First principle, portfolio sizing. Silver should be a percentage of your portfolio that you're comfortable with going to zero. Not that it will, but that you could handle if it did. For most people, that's probably somewhere between 5% and 15%. Not 50%, not 2%. Enough to matter if the thesis works, but not enough to devastate you if it doesn't. Second principle, time horizon. Don't put money into silver that you need in less than 3 years, preferably 5 years. Volatility over short periods can be extreme. Over longer periods, fundamentals tend to assert themselves. Third principle, rebalancing discipline. If silver becomes 30% of your portfolio because it's tripled, trim it back to your target allocation. Take some profits. Let winners run, yes, but not to the point where one position dominates your financial life. Fourth principle, stay liquid. Keep cash reserves outside of your silver position. Don't put yourself in a situation where you have to sell your silver to handle an emergency. Forced selling in volatile markets is how wealth gets destroyed. Fifth principle, continue learning. Markets evolve, conditions change. The thesis that's valid today might become invalid tomorrow. Stay informed without becoming obsessed. Read multiple perspectives. Challenge your own assumptions. Step back for a moment from silver specifically. What are we really talking about? We're talking about trust. Trust in currencies. Trust in governments to manage debt responsibly. Trust in global systems to provide stability. Trust in the idea that paper claims are as good as physical assets. That trust isn't breaking everywhere all at once. It's fraying at the edges. It's being questioned in certain regions, certain demographics, certain contexts. But once trust starts eroding, it's hard to restore quickly. Silver's move isn't happening in isolation. Look at gold. Look at copper. Look at energy markets. Look at food prices. Real things, physical things, are repricing relative to financial things, paper things. This could be a temporary phenomenon. Central banks could reassert control. Inflation could moderate, debt could be managed, globalization could resume. All of that is possible. But it's also possible that we're in the early stages of a longer cycle, one where the monetary experiments of the past 15 years reveal their costs, where scarcity in physical resources asserts itself, where geopolitical fragmentation creates winners and losers. In that scenario, owning some real assets isn't speculation. It's prudence. It's diversification. It's acknowledging that the future might look different than the recent past. We've covered a lot of ground. Let's bring it together. Silver blasting past $100 in Chinese physical markets is significant. It's a signal about supply, about demand, about monetary conditions, about the gap between paper and physical. Whether it's the beginning of a major move or a spike that corrects quickly, we'll only know with hindsight. What matters is that you understand the forces at work. You understand why this is happening. You understand how to think about it rather than how to react emotionally to it. If you hold silver, maintain discipline. Don't get greedy. Don't leverage up. Don't assume this price is permanent. Stay grounded in your original thesis and adjust only when fundamentals change, not when price changes. If you don't hold silver, don't chase it out of fear of missing out, but also don't dismiss it out of stubborn skepticism. Look at the evidence. Look at debt levels, at supply constraints, at monetary policy, at geopolitical trends. Make an informed decision about whether some allocation makes sense for your situation. And regardless of which side you're on, remember that nobody knows the future. We deal in probabilities, not certainties. We manage risk, we don't eliminate it, we stay educated, we stay disciplined, and we adapt as conditions change. The crisis that's here isn't necessarily a financial collapse. It's a crisis of the old assumptions. The assumption that debt doesn't matter. The assumption that currency printing has no consequences. The assumption that paper and physical are equivalent. The assumption that global systems will always provide stability. Those assumptions are being tested. Silver is one of many canaries in the coal mine. Whether it's the canary that matters most, time will tell. What matters today is that you're thinking clearly. You're not panicking. You're not blindly euphoric. You're educating yourself. You're considering probabilities. You're making decisions that align with your risk tolerance and your time horizon. That approach, that discipline, that commitment to understanding over reacting, that's what separates investors who build lasting wealth from those who chase stories and get burned. Markets reward patience, punish emotion, and always, always teach humility to those who thought they had it figured out. Stay informed, stay disciplined, stay humble, and understand that in times of transition, the investors who do best aren't the ones who predict the future perfectly. They're the ones who position for multiple scenarios, who manage risk intelligently, and who maintain emotional control when everyone around them is losing theirs. That's the opportunity here. Not to get rich quick, not to time the perfect trade, but to be thoughtful, prepared, and positioned when most people are confused, reactive, and exposed. Thank you for watching. Thank you for taking the time to understand rather than react. And whatever you decide to do with this information, make sure it's your decision, made with clear eyes and honest assessment of both opportunity and risk. The markets will do what they do. Your job is to make sure that whatever they do, you've positioned yourself to handle it.